Welcome to the Hedged Edge by RCM Ag Services, where we're getting out of the field and onto the mic to bring you weekly market updates, commentary from commodity experts, and monthly interviews with the biggest names in agribusiness. Welcome to the Hedged Edge in the first episode of 2023. As always, I'm your host, Jeff Eisenberg. Today, we'll be taking a break from commodities and diving into the world of equities, interest rates, as well as tax savings and business planning strategies for the new year. Our guest today is Tim Webb. Tim is a close friend of our sister company, RCM Wealth Advisors, where he's the chief investment officer and managing partner. Tim has been working as a portfolio manager and advisor to families, institutions, and agribusinesses, implementing no-nonsense financial planning strategies and market investment disciplines to help clients build and maintain wealth and reach financial goals since 2003. Tim, welcome to the show.
Thanks, Jeff, for having me. Appreciate it.
Absolutely. Hey, last time we saw each other, I think it was on the golf course. And correct me if I'm wrong, but pretty sure I was standing on a green that you drove absolutely over the green.
It went over, yeah. I want to be clear on that. It carried the green. Yeah.
How is that possible? So you grew up playing baseball. I mean, some people say golf and baseball don't mix, but from what I see, it's a perfect match.
Well, I've always been somewhat of a big hitter. I batted fourth pretty much my entire career. Initially it did not mix. I was having the banana slices all the way into the woods and all that other stuff. And if we're talking advice here, I'm going to give two quick driving tips, I guess. The first one would be try to transfer a little bit of weight to your front foot. That helped me out a ton. And then really just kind of driving down into the ball and through it. And if you're looking for power, the one thing that I've realized is that I do swing hard. That's neither here nor there, but where I generate my most power is because you're in a small confined area, is you actually have to push down into the ground and up. You have to figure out how to generate a lot of power from a very short area, right? So I kind of drive my feet into the ground and then come up at the point of impact there. So
wow. So you're not only offering financial advice, you're also offering golf tips. So which one do people take you up on more frequently, I guess is the question.
Well, the only benefit in golf I can do is with my drive. My short game is horrendous. But yeah, no, I enjoy it. I've joined a league in over the past 3 years. So I've improved markedly my golf a little bit. So I get out I try to get in 18 holes a week if I can.
Right.
Yeah. So it's nothing great. I'm a mid 80s shooter. So don't, other than the drive, that's all I can impart on this conversation.
Okay. Well, I'll put you on my scramble team for sure next time we play, but
those I do well at scrambles. Yeah.
Yeah. 100%. Great. Well, so excited to have you here today. We've been obviously working together in parallel for a long time now. And, the markets, what we're going to talk about is a little bit about the markets. And, before we jump into that, I think it might be helpful just for anyone listening in, just to give a little bit of your background. I mean, you started RCM Wealth Advisors over 10 years ago with Bobby Schwartz and, the CEO of RCM Alternatives and Ag Services. What can you tell us about this journey? I mean, 10 years ago, all we had to do was stick our money in the markets and we were looking pretty good 10 years later, but it's a different world now.
Yeah. Well, especially in the overall wealth management space as a whole. So I started my career back in 2003, started with a great regional firm, AG Edwards. And after about 4 or 5 years in there, I remember going down to a meeting at their St. Louis campus with the CEO, and I won't mention names with that, but the CEO was asked, and it was like around 2007, I guess, right around there. I was close friends with the Gallatin family who had started AG Edwards, and I remember the question was, "Hey, would you ever sell this firm?" And he's, quote unquote, "Over my dead body, would I ever sell this firm?" 11 days later, he sold the firm, right?
Gotcha.
So from there, it went to, I think it was Wachovia at the time, if I can't remember offhand. I didn't necessarily want to stay with that firm, so I ended up transferring over to Smith Barney at the time. Then you hit kind of the 2008 financial crisis. Citibank broke the buck. Smith Barney was kind of their crown jewel of assets for the bank at that point. It was at that point, it seemed as if we were going to be buying some other groups. I remember calling some of my friends on the street, like, oh, they were calling me. I said, oh, I hear we're buying you. They're like, oh, we hear we're buying you. I'm like, okay. Eventually they, Morgan Stanley and Smith Barney, decided on a joint venture, which eventually turned into Morgan Stanley long term. They were offering up some deals. I didn't necessarily want to take any kind of deal from them. So at that point in 2009, I opened up an independent office, went to the RIA model, right? So there was, a brokerage RIA, but it was through a local outfit. And that local outfit was eventually swallowed up by Charles Schwab. So then,
yeah, that was an interesting time because the RIA model is so different than the traditional stock brokerage model, right? You're really taking an entire look at someone's financial plan as opposed to what stock can I pick that's gonna be the next hot tech stock or something along those lines.
Yeah, it's totally true. And the biggest thing with that is really kind of becoming a fiduciary, right? So once you go to the RIA model, it's so much different than it was back when I started in 2003. When you go into the RIA model, you're sitting as a fiduciary to your clients, and you're sitting on the same side of the table, right? You're not making any commissions off of their business. You're charging a fee for service and advice, adding value, and not necessarily pushing any product to any one person and or client, right? So the idea is what is best for that individual, that corporation, that non-for-profit that is going to help them and all those people that might be within that organization. And you push forward from that standpoint. Now, from an overall business, I couldn't like that any better, right? So, there's from the situation of having to say, okay, well, what is best? How do we go the best? How do we go about getting our clients to that end goal? And that's where the RIA model, in my opinion, the Registered Investment Advisor model, is best suited for the lion's share of clients. And you're starting to see even the big banks and all of that stuff trying to push their business more towards that arena.
Yeah, listen, everybody is an expert at their business, right? At this stage in the game. And we want to let them stay experts at what they do and bring you in to piece together the financial elements of it makes sense. And then also your global network of additional service providers or partnerships, allow for you to then also kind of be at the helm of some of these organizations, whether it's a farm, an elevator, somebody that's touching in traditional agricultural businesses, or, obviously not inside our markets, but other types of companies and businesses that you work with elsewhere.
That's a great point. One of the main things too, and where you can continue to drive value for your clients, is trying to figure out ways that you can help their business in every aspect, right? So be it bringing specialty farm insurance to different groups, bringing estate planning, wills, getting, essentially negotiating on behalf of your clients with these groups, going to different outfits that may do those services and bringing some volume to them so that you can bring the volume discounts back to your clientele and say, okay, well, here's what we've negotiated. This is, these are the experts in these fields, and they're going to bring this to you, and it's most likely going to be less costly than you would going out on your own, right? So that's kind of the big thing, and kind of bringing that full suite of services to whatever client base we're chatting with, organization or otherwise, right?
All right. Well, we've got the elevator pitch down now, so let's flip over to the important stuff. What is not that doesn't count, but people want to know, and I do too. Where are we going with stocks, the stock market, and interest rates coming up here in the new year here. We're, obviously market end of the year down terribly, almost as bad as 2008. And then you referenced the 2003 period when you started. That was another terrible period. But, I guess first question is there a beacon of hope, or is it all doom and gloom here? What are you and your team looking at right now?
Yeah, so obviously, the big and maybe you'll have questions about this later, but the big thing that are on a lot of our clients' mind is, okay, is there a recession coming?
Correct.
Some people believe we already are in it. Some don't. And then
I'll tell you, my Costco bill tell me we're going to be in recession. I can't believe the prices. I'm going to hit the brakes and send my wife to the store.
Yeah. Inflation, that's obviously another big situation, and we try to inform on that as well. But yeah, with respect to, is there a recession kind of looming, hovering over us? The answer, in our opinion, is yes, right? So we're kind of projecting it out probably for the second half of 23, which is where it looks most likely. Everybody who's been in the markets understands that this past year it didn't matter what you're in. You could have been in stocks, bonds, Bitcoin, silver, gold. It seemed like everything was, really tracking backwards. And in a lot of ways, in a typical recession, some of those things might have worked, even in the corporate bond space, or those high grade corporates, or, mortgage backs should have done a little bit better than they did. So everything kind of really took it on the chin. Some of the numbers.
You have to take a pause there and make a plug for the alternative side here. Trend following CTAs have had a great year, double digits. So let's not forget about where there can be potential is commodities. Since we're on a commodity podcast, we got to remember there was some positive numbers out there.
No doubt. I've been seeing those numbers from you guys, and they are quite impressive. I would definitely agree with that. Yeah. So yes, there's always some place where you can kind of look. It was just more difficult in 22, right? There was, to put it lightly, I guess, to really look back, because they started raising interest rates so aggressively and above expectation, way beyond what they were predicting, right? Like at the beginning of 22, I believe they were kind of coming out saying, yeah, we're going to probably employment looks good. We're probably going to have 3 25 basis point rate hikes throughout the year of 22. Well,
exactly. Just complete change of course.
They did that in 1 month, right? They did
unprecedented. Right.
Yeah. So we've just seen this happen fast and furious. And the other big thing that we look at and what there's a lot of froth still left in the markets, right? So, from a standpoint of M2 money supply, right? So there has just been, because of the pandemic and everything else like that, there has been a flood of money that's been put out there, be it through different government programs, things like that, different bills that have passed. But there's been a lot of money, and that has kind of pushed through the system, and still has a way of working. It has some more time that it has to work its way through the system, if you will. So now, moving into 23, you can see the Federal Reserve kind of saying, okay, well, we're looking at some of these things. We just did a 50 basis point hike. Some are projecting another 75 basis points. And one thing that we're seeing a lot of is that, if 22 is any indication, I don't necessarily think the best place to look is what the Federal Reserve is kind of touting right now, right?
Of course, they've been dead wrong. I mean, why should we believe them, right?
I agree. And the worst part of it all is the markets are trading based off of what they're saying and all that other stuff. It's not based off of fundamentals. It's not based off of even, tracking. It's all based on what is the Federal Reserve going to do? What are they going to say? What are they going to project out? And that's not a good place to be overall. And I do think in 23, that narrative starts to change a little bit, right? So eventually the markets do tend to always go back to, okay, what's the valuation that I'm at right now, right? Where can I find future growth and future prospects for different companies? And once we start getting back to the fundamentals, which we do believe will happen in 23, be it in the bond markets, be it in the stock markets, we do think we get back to some normalities where we're going off of what, earnings, because obviously you're going to have compression in earnings. That's going to trickle through. That's probably what's going to trigger the recession that we think. is forthcoming. On top of it, you're going to probably see that the Federal Reserve is going to kind of keep their foot on the gas a little bit till you get closer to more of a 5% unemployment rate versus staying at the 3.5% where it's technically quoted at right now, right? So, so there's going to be some of that coming off the system, which, with respect to stocks, that we don't necessarily think that's the best growth environment. So for some of those cloud computing companies, some of those, even some of the big aggregate tech companies, they're facing headwinds throughout that. So, our goal is kind of looking at, okay, what dividend paying stocks, value-based stocks are we looking at? We know there's going to be some volatility that comes through here.
Right,
you can utilize some option work with that, utilizing covered calls. And we have something we call our triple income strategy where we're doing different things to kind of generate synthetic, I don't even want to call it synthetic, but generate options premiums to kind of get some of these dividend paying stocks at a better price, do a covered call or a call spread on it on the back, and really kind of mitigate some of that volatility that we saw throughout 22. So we think that strategy in 23 looks to be a little bit stronger than saying, okay, everything is dipped back so bad in the tech space and the growth companies that it's got to be a good time to buy it. Could be.
It really, it's what if I could summarize what you're saying there. At the end of the day, hope is not a strategy, right? And you really have a view of where things need to go or are potentially going, and then being tactful in how to allocate. It really kind of falls on your shoulders a bit. I guess a question that comes to mind is, historically, people have been successful with passive investments versus the active type of investment strategies. And I know you and your company, you've mentioned your strategy, have had quite a bit of success on the being the tactful or active side. Maybe just talk a little bit about that. Not too detailed. I mean, you are talking to commodity traders, so we understand covered calls and option strategies, but just high level, what are some of the more active approaches you take to that?
And speak briefly on the passive stuff. Yes, over the past 10 years with easy money, it was kind of a point and shoot situation, right? It was if there's 500 targets out there and you hit a few of them, it's gonna be fine, right? Like that's what was good under easy monetary policy. Obviously, it's gotten a lot more difficult now that the volatility has ticked up, and also that has come to kind of a screeching halt from an M2 money supply aspect, right? So that in 22, right around October, has pretty much gone to, it's still a little bit going on, but it's pretty slowed down substantially, right? So with respect to that, the way that we look at it for 23 going forward, you take a passive index, let's just say the S&P 500. A lot of times people say, what, I'm going to put that in there. Okay, so just based off of what I said before, that's a market cap weighted average, right? So that the biggest companies in the world are going to have the most amount of exposure in that S&P 500 fund, right?
Right.
So you're going to own all the Apples, the Googles, the Facebooks, Meta, if you will, all of those. That's going to be comprised of about 35% of your portfolio, between 30 and 35% of your portfolio, based on market cap weight. And you're technically moving more towards kind of a technology-based portfolio with respect to that. In our opinion, in this upcoming year, value-based is going to be more the healthcare sector. A little bit, maybe financials have been hurt a little bit, but those potentially could do okay, being that we're in a somewhat of an abundance type of atmosphere with the Federal Reserve type of thing. So the one strategy that we employ is, obviously we want reoccurring dividends that have consistently increased over time, that we think that are going to continue to, they're not going to get hurt too bad throughout any kind of recession, because they're built-in businesses. They're the steady growers. If you can get 4 to 6% in market return, and you got a 2 to 4% dividend, you're looking at a 6 to 8% return overall. And sometimes you just got to take what's given to you in that particular time, right?
Quick question comes to mind right there. So with cash rates as high as they are now, 3 to 5%, cash rich companies, are those ones that you're thinking about? Because ultimately they're going to earn interest on money. It's in excess cash, plus potentially throwing off profits from the from the business actual revenues? Is that something that you're thinking about?
Absolutely. Cash is king, right? That's always the, we do what's called discounted cash flow analysis or discounted cash flow, kind of reporting on companies. So we're always looking, okay, what's the cash look like? What's their ability to continue to pay those dividends? What's their growth model? Because, be it with inflation still at high levels, right? There are certain capital expenditures that different companies were paying for in the past, right? Wage growth was kind of moving up pretty quickly because, you had easy monetary policy, and that kind of trickled down through all the ranks there. So definitely cash is going to be king, in our opinion, 2023. It typically always is. But those high valuation stocks, while they may be cash rich, they're still trading at multiples that are well beyond what we think that could continue in 23 there. So it's just more of a conservative approach, right? Just to start off the year. It's not that we can't pivot, because at some point, and I don't want to be all doom and gloom on this. I do think at some point there's going to be a great buying opportunity, both in bonds, because those have retracted so much, and even in those growth stocks. I mean, I think the market is waiting somewhat for an all clear sign, but I want to put that in perspective as well, right? So we've just gone through 12 months of the market, starting in January, the market just started tanking in 22, going down. We've had a couple pockets. We had about 9 or 10 situations where the market tried to rally and failed throughout 2022. We do think that tends to continue into 23 a little bit. But with that said, if we do go into a recession, markets will be trying to get out. They'll be the first things to recover, right? So typically recessions last anywhere from 2 to 18 months as a whole, right? That includes 2008, and includes back for the past 50 years. So, we're 12 months into kind of a retracement in equities, and we do think that I don't think we're going to hit the long end of that 18-month, but I think for the first couple of quarters, I think it makes sense to play it safe. Dividend payers, things like that. The other thing is, this is something that we've been doing. We've been kind of doing a laddered CD strategy. I haven't bought CDs for
CDs.
Clients.
I mean, Are you talking about the ones that we listened to on our old Discman, or what is a CD?
I'm telling you, well, it just, the appetite for risk right now is very, very low is what I would say with the client base that we deal with. Right. So that's also, if you look at it from the contrarian standpoint too, that's also an opportunity. Like you may want, when things it's that old Warren Buffett, saying is that, be greedy when others are fearful. We're starting to hit some peak fearful levels right now, which from our standpoint, we look at that as an indicator of good times ahead a little bit. Right. So when we come out of these type of recessions, you have the largest, I mean, you can look back and you're going to be looking at 45 to 50% returns potentially out of these recessions in a not too short time after that. And stocks will typically run 6 to 12 months ahead of that recession actually being over, right? So I don't want to get too fine with the strategy saying, okay, you got to do this and you got to wait until you get an all clear sign. That might not be the case, right? So it's a situation of, we know where we're at. We're about 12 months into this retracement. We know potentially it could last 18 months. If it went a little bit longer, okay, historically now we're passing some levels. We had a pandemic that was pretty large and had quite a bit of an effect. We've had easy monetary policy that they're pulling back. Oh, and by the way, we got $32 trillion in debt at the government level.
Yeah, let's not forget about that. Another 1.7 here at the end of the year, or whatever the number is. Yeah.
I saw it. I don't. If I think that'll probably pass, but we'll see. So yeah, and it's just one of those things where you want to play it safe a little bit. But as I was saying, with the laddering of the CDs, we've been doing that, but we're doing short term, right? So you're able to get, on 1 month, you're getting 4% type of returns, 4.2%. Now it's annualized, right? So, but we're kind of laddering that, so that we're doing it month by month on that. And then as the interest rates are being risen, sometimes the CDs rates are rising in kind. But we also want that liquidity available to us, so that if the markets do turn, we don't think they're going to turn on a dime, but we do want to have some availability with some of the capital to then be able to put that to work for our long-term strategy, right? In these situations, what we're going through right now, you got to kind of battle in the short term find your pockets, get in there. And then, at some point we want to get back to a long-term strategy because we do believe markets are going to do fine over a long period of time. Historically, they always have.
Yeah, I can completely appreciate the long-term view. And I think that kind of leads into the next section here, which is kind of transitioning away from what markets are doing or anticipated doing to, really building a business, long-term business, and the planning and structure around that, I think, is super important. And, making money in the stock market or in equities or bonds is one thing, but the other side is also extremely important. How about saving money in taxes, or preparing your infrastructure and your business to be able to pass on to either other employees through employee benefit programs, ESOPs, other things like that, or succession planning if you're a small business, a small farm, or even just a small business, passing things along those ways. So if you could just maybe shift over a little bit, Tim. And I mean, there are many other strategies that people should be thinking about, that outside of just where do I, what stock do I buy? What, how high is the stock market going to go from here?
Yeah. Yeah, good point. So, from a tax planning standpoint, for our clients, businesses, organizations, farmers, that is something that we concentrate pretty heavily on. So we're fair, the corporate benefit space is something that we're in, and we look at it very heavily, and we bring that to our business owners as a great benefit.
Large or small businesses, right?
Absolutely. Yeah. It could be individual owner only type 401ks, right? And they didn't realize that they could potentially get, $67,000 off of their taxable wages by setting something up for themselves and their wife, what have you, or wife and husband, opposite way. So it's one of those things that we really try to help from a financial planning standpoint. So we're talking about market strategy, things like that. This is more under the financial planning, wealth management portion of our business. So in the corporate plan space or even just retirement space, right? As I mentioned just previously, we're $32 trillion in debt. What does that tell us, right? It tells us at some point, tax rates are going to have to go up quite a bit to pay down our debt. So what do? Do we just sit here and wait for those rates to go up and continue doing what we're doing? Or do we take advantage of some of those government or, the IRS places that allows us to put money away into a tax deferred vehicle or an after-tax deferred vehicle, i.e. with the Roth portion of things, and take advantage of what we can while we can build those balances up so that in the future, because we all know they're kind of kicking this can down the road, at some point, it'll come home to roost, right? There's going to be a situation. What we try to plan for is we don't want that situation to happen right as you're going into retirement. And then, oh, by the way, tax rates had just moved up 10%. You're going to have to work another 2 years, even though you didn't necessarily plan for it, from that standpoint, right? So we're trying to prepare our investors for the likelihood or potential that tax rates could go up in the future. And one of those ways to do it for businesses and individuals is getting the proper retirement planning piece to your business or your individual aspect in place, and be prepared for the unknown, right? So that's the big takeaway I would give.
Yeah. And I think that, a lot of people end up just putting a lot of trust in their accountants to tell them exactly what to do here. And I think that the accounting community does a great job giving advice, but at the end of the day, you partner with accountants to help them be more successful in advising their clients. And I think that, any accountants that are listening in here, let's all work together, because at the end of the day, if, all parties are swimming in the same direction, it's going to be a lot faster boat, right?
Yeah, no doubt. A lot of times. So that's part of that financial planning process overall is, many times, I often say, like, your money is your business, right? It's right. You Inc., right? So
you sound like Jim Cramer. Isn't that his line? Your money, your business, or something along those lines?
Oh, I don't know.
Okay. Don't steal it from him. He might come back.
Yeah, well, yeah. If he said it, I must have heard it in passing. But I've been saying that for years. But it remains true, right? So you have to run your money like your employee, right? So you're putting your employee out into different markets, And if they're not being productive, then they're a non-productive employee, and you need to get rid of that employee in some sense, right? So, and that's also with taxes, right? So a lot of times in the financial planning process, whether you have your own accountant that you love working with, or if you're looking for one, we have partnered with different firms in that regard that have a very sound track record of working in the financial planning process. But we oftentimes will do conference calls. You got to have your own management team and run your business, right? So we work with them and their accountants to say, okay, well, here's what we're looking at. It could be Roth conversions throughout time. It could be, okay, here's where we're at from a business standpoint. We need to figure out a way to get $150,000 off of the company books. How do we do that from a proper retirement plan standpoint? Things like that. So that, and when you start getting that out and you're paying less taxes year over year, and that money is now growing for you versus going in reverse back to the government, that's where that starts to bifurcate, and you get, okay, we're going up this way as opposed to paying that way, right? So, and then all of a sudden you continue to build on that, and then come retirement, diversifying your tax liabilities, be it through some Roth pieces and the like, cash balance plans. Then you can kind of have a situation where you've also done proper tax planning all the way through your accumulation phase. And when you get into your withdrawal phase, because we always kind of talk about there's two phases to your retirement. Right now, if you're not retired, you're building your business, you're building your individual net worth, and you're accumulating the assets that you need to build so that you can retire. A lot of times you'll work for 30, 35 years, and with the advent of new medicine and a lot of new cool kind of technology coming in from stem cell and all that other stuff, people are going to be living longer potentially, right? And you might be working for 35 years and then in retirement for 30 years, right? So now you're not making that income. How do we account for that in the future? And that's where that financial planning process comes in. We basically look at it year over year, figure out how to get you to that end goal so that you don't have to go back to work when you're 82. You're like, wait a minute, I didn't realize I should have done that.
Are you going to be able to hit the ball as long as you are at 82?
I'm going to try. I definitely, nowadays, because I swing so hard, it's a couple Advil before the round and a few Advil after, right?
Maybe something else help as well.
It's one of those things, got to get, maybe it's something to ease the pain, if you will.
Ease the pain. No, this is it. And I think in terms of easing the pain related to your retirement planning, I think that what you guys are doing is phenomenal. Excited to be partnered with you guys in this project and venture to, get this story out and message to more of our, farming and agribusinesses that are out there, small, medium, large. I mean, at the end of the day, particularly in agriculture, the business has grown exponentially. A small country elevator is now a mid-sized country elevator. A farm that was historically, had revenues $1 million or $2 million is now, 4 or 6 or 8 million in revenue. And, there's a lot to manage, and, there's a lot of work that needs to go into making sure that these businesses that used to be more family run continue to be family run and then grow, pass on, and ultimately are successful for many generations to come. And that's why I think that this discussion is super important today, and really wanted to have you on here, Tim. So
absolutely. Hey, I'm an Indiana guy. We got a great farming community out here and everything like that. So yeah, we're obviously land and everything is done very well, and what we like to do is we like to bring those services out to them, because a lot of times, there's not many alternatives in a specific area for them, where they can take advantage of a different perspective or something along those lines. There may be only 2 shops in their entire, 30 square mile radius, and they don't want to travel out, so we go out to them, we sit down and chat with them and all of that stuff. So it's, just want to let people know that they have options that they can choose from. And it's more of a holistic approach, looking at the whole piece of the puzzle for you. So.
Yeah, this has been great, Tim. Really appreciate this. I think what we'll do is catch up with you here, maybe quarterly, to see what's going on with markets and touch base on any new updates related to these planning strategies as well. And, other communities, we have an office out in Kansas. You've got the new office there in Crown Point, Indiana. Like you said, it's, right there in farm country, and continue to grow. So congratulations on the business. One last thing I'd like to ask here before we wrap up is, first of all, you've kind of already given us your market prediction. You think that markets are forward looking and likely to make a turnaround here at some point. I'm not going to stick a number on it for you, but it sounds to me like that's your 1 point. And then second is, if you had to kind of go back, you got 21-year-old body right after you graduated college, and you were going to go play in the major leagues. It sounds like, let's say that didn't work out. What extreme sport would you find yourself interested in, getting after?
I would think I'm currently looking into it as well, even at my becoming more advanced age here, rock climbing.
Okay.
And, also in an odd way, boxing. So my father was he was the heavyweight Bengal bout champion at Notre Dame for 2 years running. So, that would have been, it's extreme, I guess. It's kind of a fight sport. That would have been something, kind of on those stressful days when the markets are down, a little boxing would have been okay too. But yeah, currently I'm looking into some rock climbing options for myself. Not a ton out here in Indiana overall.
Yeah, I was going to say, probably not right in the heart of rock climbing area, but could certainly, I guess I know what to get you next year for Christmas. I get you a boxing bag or a heavy bag there for the office. You could play ping pong, and then the loser, after you lose to the young bucks, you have to hit the bag. So
they can't beat me, just so you know. As hard as they try, it's not going to happen. So
perfect. Well, Tim, really appreciate you coming on the show. How do people get in touch with you? What's the best place to reach you?
Yeah, so we're at, obviously you see the RCM Ag Services. So we are RCM Wealth Advisors. So it's rcmwa.com. So you can check us out there, and our number and everything, contact information. A lot of our groups listed on there as well. Not all of our strategic partners, but a lot of our interior group is listed on that. So yeah, we're happy to help in any way that we can. Big or small, to your point, it doesn't matter to us. If you have questions, it's a no obligation. We're here to help. If you need some help, give us a call.
That's perfect. Yeah, and then the tie in with the ag services piece, we can obviously we could talk about both sides of the market at the same time. So
more to come on that, right? There's more to come on that for sure. So
we'll keep everybody posted. But all right, Tim. Well, thank you so much for your time. Super great to see you. Next time we'll get another round of golf in, and catch up for a game of ping pong. But thanks again, and enjoy the rest of your your new year coming up.
Absolutely. Thanks for having me. Appreciate it.
Thanks, Tim.
All right, take care.
You've been listening to The Hedged Edge. Links from this episode will be in the episode description of this channel. Follow us on Twitter at ag_RCM, like our Facebook page under RCM Ag Services, and visit our website to read our blog and subscribe to our newsletter at rcmagservices.com. If you like our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear them. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.